All right, I think we are live. Hello, everyone, and welcome to Stock Market After Hours. My name is Mark Rusin. I'm a CPA here in the state of California. If this is your first time joining our live show, welcome to the show. What we like to start off is seeing number one, who's out there watching the show? Number one, where are you tuning in from? So where are you watching from? And what have you been buying or even selling? Let us know down in the chat. And if this is, again, your first time joining, this is intended to be a show where we not only talk about the stock market, some high level things that we're going through, but get some ideas from everyone out there, because our sole focus here is to kind of build wealth together. So let me know and let's make this interactive here. I got some great stuff to kind of show you guys today. We'll be talking a lot about the economy, about the Fed, some reasons that I want to be optimistic about the market, some reasons to be concerned about the market as well. So let me know, number one, where are we tuning in from? And we'll get this show started here. Consuelo from California. Are we Northern Cal or Southern? I know in that state, we kind of break things up between Northern and Southern. Jeff from Minneapolis. Matthew, good to see you, my friend. A little SCHD has been added to Matthew's portfolio. Curtis tuning in from Boise, Idaho. King David's here. Good to see you, my friend. Bought some Pfizer. Still worried about inflation and the national debt and its effect. We'll buy some SCHD, some PG, and AT&T later this month. Washington, D.C. We got a bunch of people jumping in now. We got Florida buying some Tesla. Germany, there we go. There's our first international. OKC, baby, SCHD. They got a good basketball team right now. Tampa, Florida for daily. Drew is checking in from Minneapolis, Minnesota. Upstate New York for Scott. Smiles and Giggles tuning in from Texas. Buenos Aires. Love it. Argentina. Beautiful, beautiful. New Zealand, New York City. Baloo, good to see you, my friend. A fellow Discord member. Iowa, Southern Maryland for Matt. All right, Jeff, what are we buying? Costco, Spotify, and COHR. James, good to see you. Tuning in from Vegas. Bought a little Target on the dip. Seems like that one just keeps dipping, right? All right, Fullerton. Now we're getting close. So I'm here in Orange County, so that is not too far away from where I'm at. Daily, some more SCHD, a little SCHB this month as well. Not one that we hear too much about all the time, but good to know someone's buying there. New Jersey for Tom. All right. What's up, Mark? Ty in Seattle. Finally made it back. Sold out of Coca-Cola, NVIDIA, and Home Depot. Consolidating my positions, freeing up funds, and want to pick up some Johnson & Johnson, Procter & Gamble, waiting for them to dip. So Johnson & Johnson's kind of been in a rut for what seems like has been much of the past year or so. But we finally have, when we've seen a lot of this money move away from high-tech Mag 7 type stocks, a lot of money went into the value stocks, and a lot of money went into Johnson & Johnson as it went from 140, and now it has had a nice little run. Dublin, Ireland, tuning in. Marco from Naples, Florida. We got some more Tesla. Oh, this is double Tesla right here. We got the 2X Bull ETF. Okay. They've had a rough patch there. Jesse from North Dakota. Chi-Town's in the house. Jeffrey Hatch, good to see you, my friend. Microsoft, Amazon, and SCHD. Love all three of those and love all three valuations. Consuelo, Los Angeles, buying a little VTI. So Southern California there. Friendly neighbor in Canada. Good to see you. Robert, or Bob, sorry, from Detroit. Edgar, Florida's dominating today. John Bircher, good to see you, my friend. Little QQQ action. Awesome. Early on, we are already up over 100 people here. So this is awesome. Again, great to be with you guys on this Wednesday Stock Market After Hours. And if this is your first time joining, welcome and thank you for joining the show here. So, all right. Let's jump in and let's start with our slides here. Let's go right after the slides, get the comments off right here, and let's go through. So we're back to the slides. I know last week I kind of like to show you guys, sometimes we'll use the iPad, sometimes we'll have the formal slides and go through my screens that I have up and stuff like that. Today's going to be more of the formal route here because we have a lot of information that I want to get through. So kind of our economic update, where are the markets as it stands right now? So on a year-to-date basis, we could see the Dow Jones down 1.7%, actually the best performer of the three main indices there. S&P 500 down nearly 4%, and then the NASDAQ, to no surprise, down 8% year-to-date. The Russell 2000, which is our small caps, is not having a great time right now, down roughly 6.5%. Oil hasn't really moved all that much. We got up into the low to mid 70s. We're kind of hovering around that range, slightly below at $67 per barrel there. And then we have Bitcoin, which has been volatile. We were well over 100 for quite some time. We dipped actually into the mid 70, low 70 range there for a short period of time, and now we're back hovering in the mid 80 range there when we updated these slides here. So kind of give you an update of where it's at right now in terms of Bitcoin. Still hovering around 85.8 right now. So it's up $400 from when we put these slides together right here. So in terms of valuation, we're going to talk a lot about this as we continue on in today's show. Right now, the S&P 500 is trading at a forward PE multiple. So that is using the end of year 2025 EPS estimates, which is still at $270, giving us the valuation of 21 times. Again, if you've been joining this show, you have seen us update this metric on a weekly basis. We were up in the mid 22 range, 22.5. Historically, the 10-year average hovers around 18. So we've historically been in that overvaluation period. Now we're starting to see valuation come back to matter again. And I always like to say it is definitely always going to matter. You can definitely go through these big bull periods like we have in the past 2 years where valuation just didn't really matter at all. You had stocks that were just trading at outrageous valuations. And now we've had big gains in these stocks. And a lot of big investors, big money managers are saying, hey, it's time to take our profits. We have to take some profits after that year that we've had. And they may also have some concerns about where the economy is or where the economy is potentially going. So again, they definitely want to lock in those returns. And that's, again, a big discrepancy between dividend stocks and growth stocks. Growth stocks, the gains are fantastic when you see them in your portfolio, but they're nothing until what? Until you actually make the sale. With dividend stocks, you kind of get a little bit of both. You can get that share price appreciation, which you're not going to get the gain until you sell. But at the same time, you're earning money. You're earning dividends on a regular basis, a quarterly basis, a monthly basis, which kind of helps offset some of the volatility that could be going on in the market. At least you're seeing real money come into your portfolio there. So interest rates right now, we have the 10-year and the 2-year. The 10 years at 4.25, the 2 years at 3.98, so slightly below 4%. Those have steadily been coming down over the past few months, which is definitely a good thing and something that I think, this administration is trying to do here with a lot of the wording and the verbiage that they use with about resetting the economy and all the hard line that they're taking on tariffs right now, as opposed to the first time around with the Trump 1.0 administration. These tariffs seemed more like a negotiation ploy. This time they're sticking with them. It seems like a lot longer and playing a little bit harder ball there, and they're seeing the impact it is having on the stock market in particular. Some can say the economy, but the stock market for sure. We can see the numbers there. But I think there's also a lot more fear that's been putting in, if you look at all the news agencies and things like that, on as if the whole market has just completely collapsed here. And when we look at the S&P 500 and when we look at the Dow Jones and the NASDAQ, it's again a top-heavy bear market that we're in, a top-heavy correction that we're in. Because when you start to look at value plays and when you start to look at the likes of SCHD and you start to look at equal-weighted indices, things are actually quite fine. So again, when we look at the S&P 500, it's important to understand that it is a market cap weighted. The largest companies carry the most weight. The largest companies like Tesla and AMD, even Amazon, Microsoft, these companies have had a tough time so far at the start in not even 3 months here in 2025. So when those companies don't perform well, it's going to impact the S&P 500. It's going to impact the NASDAQ a lot more heavily than if companies 200 through 500 have terrible down periods and things like that. So it's important to understand that context there. And again, when we look at the S&P 500 over the past 12 months, we're still up 10%. So let's take a step back here sometimes. And sometimes you just got to zoom out and say, hey, maybe it's not as bad as we think. We're going just through a period of this reset where some money managers are moving money around. Now, if everything was selling off and we were seeing the big stocks come down and we were seeing even the value plays and really where nothing is working and maybe just a few sectors, a few defensive sectors, that's a time that investors need to really be concerned. But that's not yet what we're seeing. I'm not saying that's not where we're going, but that's not what the data shows right now. And it's important to look at the data, not listen to the news all the time. Okay, so that's point number one as we get things started here. And again, I think we have a great show with a lot of great points for you guys. I made the points, so I hope they're great from that standpoint here. So here's a look at the Fear and Greed Index. Last time that we met, it was pretty much exactly the same. The Fear and Greed Index was slightly in extreme fear. We have moved over two more points here, still sitting roughly in that same degree as you could see extreme fear levels there. So I want to say we were at a 24 scale last time, and someone would have to go look back and so don't quote me on that. But so right now we're sitting at 22. So no real major difference. So now let's go take a look at that sector performance. What I was just talking about and saying is everything selling off and maybe just a few defensive sectors? Let's go take a peek right now. So let me jump over to can you still hear me now? Okay. So there we go. So now hopefully you guys can see my sector performance there. All 11 different sectors. As you can see, everything was green today. Healthcare sneaked out a 0.02% green day there right now. So can you guys hear me now? All right, perfect. Looks like we're coming back. All right. So now let's take a look at year to date. So we're going to look at, this is the year to date performance for all 11 S&P 500 sectors. And as you can see right here, again, all this fear that's been thrown out into the market lately about the stock market dipping into a correction. We're headed towards a massive sell-off. You know, you look at certain YouTubers that just want to be these fear moguls that just send out, it's over, I'm selling everything. Well, let's look at the actual data here first, guys. This is year to date, okay? Year to date, there is only 3 sectors that are underperforming the S&P 500. The 3 sectors are communication services, think of Alphabet, Meta. Think of, information technology, think of NVIDIA, AMD, Microsoft, Apple, all have really struggled in 2025. And then we have consumer discretionary. Amazon has struggled, but no one has struggled more in that sector than Tesla. So all 3 of those are in the dumps there. Every single other sector is actually outperforming the S&P 500. And only one of those sectors is actually red, barely. And that is industrials. They are red by 0.18%. So this goes back to the importance. You may be looking at your portfolio saying, well, Mark, I'm getting smoked based on my portfolio right now. And if that's actually the case there, then you may want to look at your diversification and see, am I well diversified or am I overexposed to technology? Or am I overexposed to some individual stocks like Tesla and Apple and NVIDIA? This goes back to the importance of having strong diversification there. So that's the first point there. So what's leading so far? Well, healthcare, energy, and utilities. They're up 6.3%, 5.9%, and 3% respectively. So we may be looking at this saying, okay, well, there's a lot of green, so that makes me feel a little bit better. But I always like to play, devil's advocate, and I want to look at both sides of the spectrum just to try and give you guys all the news. I never come in here with an agenda just to want to be, pushing just the bull side or just pushing all the fear bear side of things. I want to give you guys both sides here. So when we think about healthcare leading and energy and utilities, those are defensive sectors. So we're seeing a lot of investors move a lot of their money to these defensive value type of plays, areas where consumers have to spend money. If someone gets sick, they don't ask what's going on in the economy. No, they just have to go to a doctor and they have to spend the money. Okay. We have to keep our electricity on. We have to pay for gas to keep the heaters on and things like that. Those are areas where consumers have to spend money. Those are known as defensive sectors in the stock market. So that's kind of the other side. Again, all green for the most part for all of these 8 other sectors. Hence, outside of industrials, which is barely not green. But just a different vantage point there. Let's take a look at the past 3 months here. We can see that energy, healthcare, and utilities. So healthcare has really started to ramp up here in the past 3 months and really come from the depths there a little bit. So now things aren't looking as great. And then we know February was not a good month for much there. But again, everything's not falling off. It's just 3 sectors in particular. For a lot of these people that are out there right now that just push in technology stocks, that's why they believe the end, it's over. A recession is coming. All the stock market is going to fall off a cliff. That is because they only push certain stocks. That is because they don't build a well-diversified portfolio that can weather this. If you are a member of our Edge Plus subscription at the Stock Investors Edge, you get to see my monthly portfolio updates. You get all of my trade alerts. You know exactly how my portfolio is doing. So we just launched that. We just did our monthly or published our monthly update there. So if you haven't checked that out yet, definitely check that out as well. So that's a look at the sector performance there. Let's jump back over to the slides here and keep going with the show. Again, if you guys have questions, feel free to drop those into the comment section. I'll try to read those. I know we get a lot of comments there, and I try and browse over there every once in a while just to make sure that that I'm not missing anything in particular. So let me tell you guys about a special workshop, our favorite workshop of the entire year that we do. And we have a number of people that sign up for it and love it every single time. That is our stock options workshop. And we try and make it better every single time that we push these. We try not to do the same exact thing every time. But if you're interested in understanding how to utilize stock options the right way, this options workshop is going to be for you. Whether you are brand new to stock options or whether you've been utilizing stock options for a few years now, this workshop is going to be for you. We're going to go through a number of different strategies that I utilize on a regular basis to generate my minimum goal each month of generating $5,000 in income just from stock options. And that growth trajectory continues to climb every single year from that perspective. So we'll go through a number of different strategies that I utilize, showing you all of these I use to generate that $5,000 per month minimum every single time. And we haven't had a losing month in well over 15 months now. So, and that one month that we did have it was a screw up trade where we just had a stock just fall off completely off of a cliff. So we're talking like 40% in one particular month there. But the thing is I showed members how to get out of that, how to roll out of that. And that's the great thing about options is, no pun intended, you have a lot of options to utilize. You could use strategies that are going to be more aggressive to generate tons of income. You could use strategies to hedge your portfolio. You may be in a period right now where you are a little bit concerned about your shares, about the stock market in general, but it doesn't mean you necessarily have to sell. You can use strategies to hedge your portfolio that says, hey, if the market does in fact fall, sure, the positions that I own will reduce in value, but I'm going to make money by these hedge positions that I'm utilizing. That's the great thing about stock options. And what I always like to say is that once you start introducing stock options, that's when investing goes to the next level for you. Okay. So again, we're super excited. It's going to be tomorrow at 8 p.m. Eastern time. Again, if you cannot join us during the live piece of it, anyone that signs up, you will get the recording to this. So you'll be able to go back to it and go through this a number of times, as many as you need. But if you are on the live portion, we will have a Q&A session as well for you to ask questions there. So definitely excited about that. You can check out the link down in the description below, and you can get signed up and save a seat there. So awesome. Hopefully we'll see you guys there tomorrow. All right, so let's go to the Fed Watch tool and see what we're talking about in terms of the Fed. Today was a big decision day as it pertains to the Fed. Let me get some questions here in terms of how much money do you need to start options? Good question there, Skippy. So when it comes to options, I get this question a lot. I usually tell people a minimum of $5,000. I think more comfortably a $10,000 portfolio would be ideal, and open up a lot more. Open yourself up to a lot more strategies that are available there. But it's okay if you have a smaller portfolio. You just need to focus on a lot smaller per share prices. Again, we're never going to jump into penny stocks. This isn't a program that's going to show you how to turn $5 into $5 million overnight. If there are those programs out there, which I know there's plenty of them, that's when you want to run. because that's just gambling at that point. I'm showing you how to do it in a responsible manner there. Roberto says you need 100 shares, and that's actually not true. For one particular strategy, yes, you do need 100 shares. But for other strategies, when you were talking about credit spreads, when we're talking about debit spreads, you don't have to own any shares. If you want to own a particular stock, you could do things like a cash secured put. You don't need to own the shares at that point in time. And there's ways to roll out of that from risk management. So yes, if you're talking about one particular strategy, covered calls, you do need 100 shares. But for all of the other strategies that we talk about, you do not. So just wanted to clarify that right there. Linda said SCHD all the way. Stock market said options, you need 100 shares. Again, just went through that right there. Galactic, I'm afraid of doing options, but if we're to do options, I definitely do covered calls. Covered calls, I think, is one of the safest, and that's what they're referring to. Stock market and Roberto up top needing 100 shares, as I just mentioned, that is a strategy where you do need, and that takes time, especially if you're brand new to investing. Building up a particular position in one stock that has 100 shares, that takes time. So again, it's one of the safest strategies, but it's one that takes time there. There's a slew of other ones. This is how I get into a lot of the stocks. If I want to buy Amazon at a particular price, I don't just wait around for Amazon. I utilize strategies which are going to allow me to potentially buy Amazon at a lower price, and I'm getting paid income to wait. I'm getting paid to wait to buy a stock that I want to buy at a price that I want to buy it at. And that's the great thing about options. I'm not just setting a trade alert and waiting for a stock price to come down so that then I can buy a stock. No, I'm getting paid to wait. And that's where I like to utilize options from that specifically. Stock market said, can I talk to you directly as it pertains to options? Yes, we hold a 3-part options course, which is a one-on-one program. You can reach out, you can email me, and I can give you some more information on that if the one-on-one program is something that you want to do a lot more. And that allows us to get into a lot of examples and things like that. So D Daly says, I've never done options and I need to learn. Well, it sounds like it's a great time to jump into our stock options workshop, because we are going to be introducing these as if you have only been doing options for a few years or you've never even dabbled in them before. So it opens up. There's a lot of information. That's why we give the recording to folks, because there is a lot of information that we do go through. So you will have plenty of resources, but it's definitely going to take practice. So that's why we like to do the workshop, to definitely introduce a lot of these strategies so that you can work on them as well. All right. What do we got here? Can you do options with IRA and retirement funds? That's a good question there. You can, but there's no margin. So if you have, let's say, $5,000 of uninvested cash sitting in your Roth IRA, you can do option strategies that would utilize that much only. You can't go above and beyond that. And you never want to dip much into margin at all, even in taxable accounts, but it's very strict when it comes to retirement accounts. There is no margin from that perspective. So you can do it. I've done it in my Fidelity Roth IRA in the past. When I have uninvested cash and it's just sitting there, let's go try and do some option plays with it. If anything is speaking out to me there. I'd love to learn options as my portfolio is over 90K. Yeah, 90K is going to give you plenty of options. And I keep using that term, not on purpose there, but a number of different strategies. The door is going to be open. And that's the great thing about stock options, is the fact that there are strategies to use when we're in a bull market. There are strategies to use when we're trading sideways. And there are strategies to use when you're concerned about a drawdown, or we are in a drawdown or a bear market or a correction from that perspective there. So, this can really lock down your portfolio and bring your returns a lot higher. Okay. A lot of people think of options and they'll go, oh, that's like gambling. Well, my return to that every single time people tell me that is, sure, if you want to say that, but when it comes to options or when it comes to gambling, there's a gambler and there's the house. When you are buying options, strictly buying options, that's going to put you more in line with the gambler. What I do 90% of the time is going to be more of the house, selling options, generating the regular income on either stocks that I want to buy, stocks that I believe are too high and are likely to come back down. That could be a covered call and things like that. So we're going to go through a number of these things in tomorrow's workshop. Again, it's my favorite to go through just because, I'm obviously a buy and hold investor, number one, but options allows me to be involved almost every day that the market is open. And it is fantastic from that perspective there. So really excited for that tomorrow. John prefers some cash secured puts. One of my favorites right there, Josh. How long is this workshop for? So it's going to be tomorrow. Usually we run about 90 minutes. I'll tell you the last time that we had one in January, it went for 2 hours. So it was a very interactive group. We were going through, a bunch of different examples there. So this is going to be, we aim for 90 minutes there. And if you can stay the whole 90 minutes or 2 hours, however long it lasts, fantastic. If not, you will get the recording. So, I have had a lot of people that are overseas in Europe and stuff take this course and they watch it the next day once they wake up. Because again, I'm doing it at 8 p.m. Eastern time. They're going to be fast asleep unless you're a complete night owl or something like that and watching it at the wee early hours of the morning. But you will get that recording. So don't fret there. All right, so let's keep rolling here. Good questions, guys. Thank you for those. Definitely happy to answer any others that you guys might have. So let's jump back here to the Fed Watch tool and take a peek. Let's remove this. There we go. Now we got our Fed Watch tool up. So the next meeting, obviously we had our Fed meeting today. We're going to dive into what that means, what came out of it to a degree here. But the next meeting is not until May 7th. So today is March 19th. We don't have one. We have a nice little break here until May 7th that we will be hearing from the Fed in terms of a decision here again. And what is the Fed Watch tool telling us? So right now we are sitting at a target rate that sits right around 425, 450. Okay, that's the range that we are in right now in terms of interest rates from the Fed. Right now, based on the Fed Watch tool, 80% believe that no rate cut is coming. There was no rate cut today, and there is no rate cut coming in May, according to 80%. There is a 20% probability that believes we will, in fact, get our first rate cut. And again, as rates come down, that's going to make borrowing costs a lot cheaper and hopefully bring down the cost of debt and things like that. That's the way to think about it on terms of how can it impact the economy from that perspective there. What other? I'm trying to see all these questions over here. Mark, do you do leaps? Not as much. I've done some like poor man covered calls type of strategies in the past. Not something, a lot of my option strategies are going to be 14 to 30 days, but you can take these strategies and take them out 6 months to a year. I have a lot of people always ask me when it comes to options, well, Mark, I have a 9-to-5 job. I can't sit in front of a computer all the time. So does that put me out of luck when it comes to options? No, because I was once in those shoes as well. I haven't been self-employed my entire life. I was a CPA, worked at Ernst & Young for 6.5 years. And all we do is I take those same exact strategies and I just put the timing further out. Instead of maybe Mark does 14 days, you do 30, 60-day options. Number one, it's going to bring in more income for you right away, but it's also going to give you more time to do some risk management if, say, the option doesn't go in your favor right away. So it's just kind of moving the targets around, and we'll talk more about that tomorrow. McVane's going to be learning options someday. He'll be in that options workshop. Love it. John's going to go with 2 cuts. Can tariffs prevent rate cuts? It's all going to be impactful to the economy. So when we think about the Federal Reserve, there's really 2 things that they need to focus on. It's going to be their monetary policy and how it impacts the economy, and that monetary policy on how it impacts the labor force, the job market, and things like that. So they're kind of watching those 2 things in particular there to make their decisions. So, all right. So Fed decision day today. What happened? What was the quick recap? Maybe you missed it. Well, perfect. I'm glad you're here now. So Fed decision day. The Fed, as I just mentioned, kept rates unchanged. There was no cut, and there was 0 chance that a cut was coming. It was pretty much a 99.9%, according to the Fed Watch tool, that there was going to be no rate cuts, and that was that's what ended up happening. The Fed is still expecting 2 rate cuts, though, in 2025, depending on people who you ask. Some people thought 4, some people think 0. The Fed's sitting there right in the middle at 2. They did make a couple key adjustments, though. And one of them was to GDP. Think of that as the growth of the US economy. Their old GDP estimate was 2.1%. During this meeting, they dropped that and they believe that the economy is starting to slow a little bit. Of course, we're not in a recession because a recession would be negative GDP for 2 consecutive quarters there. But the new GDP estimate thinks that we're going to end the year at plus 1.7% there. So that's where we're at right now. So they did lower those expectations, seeing that there is some slowing in the economy. They also mentioned that they're starting to see consumer spending start to moderate. So consumers are still out in full force. They're just not spending as much as they did. So it is starting to slow. I don't think that's anything out of the ordinary there, nothing earth-shattering. And the other thing, the big adjustment that they made was they increased their inflation forecast. So prior they were at 2.5%. That was kind of where they expected to end the year. Now they're looking at 2.8%. So GDP coming down. Part of that is due to inflation remaining sticky and increasing, albeit slightly. They're looking at how tariffs are going to potentially impact an economy there as well. So a lot of things to consider when it comes to the Fed. The all-important dot plot, which some folks think is a joke. Sometimes it can be, because who knows what's going to happen tomorrow. I mean, I don't even know what I'm going to have for breakfast tomorrow. How do Fed officials know what's going to, what they think is going to happen in 2027? So it's a little funny, but I like to show it here. So heading into the year, only one Fed official was expecting 0 rate cuts. So there was one Fed official that came in and said, hey guys, based on the economy, we're not going to have any rate cuts. That number now, which if you want to focus over here on the left side, now you can see there's 4 Fed officials that actually agree. So the one remained, and there's 3 new Fed officials that say, hey, based on what we're seeing, we are going to need to keep rates higher for longer. And that's why, hence, that we started with 4 rate cuts. That's now down to 2, and we'll have to see how that keeps going based on the information that we get. So that was kind of telling from that perspective. So what should we do with all this information, Mark? That's the question that I'm going to get all the time. What should we do with this information? Does this mean we should be optimistic? I should jump in, back the truck up, and start buying because tech is down? Or is there reason to be concerned that this market can continue to be volatile and can continue to fall down? Let me try and give you, again, both sides of the aisle. Here's some reasons to be optimistic. There is what is called the Fed put. So again, as we just saw, the Federal Reserve has interest rates at an elevated rate. And if the economy starts to falter at all, and if unemployment starts to uptick a little bit, and we see an overall slowdown, they have some arsenal that they can use to help offset that. How does that happen? They can start cutting interest rates. So if they had already been cutting interest rates, like many folks already wanted them to do a while back, number one, inflation would be sky high yet again. And number two, they wouldn't have a lot of that ammo in their pocket to help if the economy starts to falter, if the job market starts to falter. So that is something to be optimistic about. Hey, if things do start to slow down, I know the Fed can jump in and help to a degree. Number two, that a lot of people are talking about, Tom Lee being one of them, is what's called the Trump put. So again, when Trump 2.0 came into office, there was a lot of optimism about the growth policies, about tax cuts and things like that. Lower regulation. You think about an area like financials. Bank of America is a stock that's high on my watch list right now after falling a little bit lower there. There's reasons to be optimistic about that particular sector and these policies here. Some growth that can come into the back half of things. And we'll talk more about this here in a second. So let's not get all crazy yet. Tax cuts we mentioned as part of the Trump put there. Lower taxes can definitely help the middle class. And that's where a lot of the spending can take place. And that can boost consumer spending again. And the economy and labor markets, if you look at the data right now, based on the data that we see, not looking at surveys where they go and talk to 100 CEOs, looking at true data, jobs added, unemployment rate, GDP, things like that, it's showing that the economy is still okay. It's not faltering too much. It's not, overheating to where we're in this crazy amount of growth. We're just kind of sitting in this middle area right now. And that's just strictly based on the data. Now, reasons to be concerned. The other side of the aisle here is, again, you see here, the Trump put. And what has that been? Has been the angle of a lot of this tariff stuff that's been going on. That's going to increase, be inflationary to a degree. But like we saw in Trump 1.0, is this more something that what we're talking about right now is just for negotiations? And maybe it won't be as high as we're talking about, or maybe it won't be anything at all. It could just be a negotiation ploy. So April 2nd is the day when things come into a little bit more clarity. More reasons to be concerned here is with the B of A survey that just came out that actually showed that investors have slashed their U.S. stock exposure more than any time that we have seen on record. More people have raised and gone into cash than wanted U.S. stock exposure. And when you look at total world indices that are out there and you take out the U.S., the rest of the world's actually doing pretty good. Look at something like the K-Web that's up over 15%. There's a lot of investors that are saying, hey, the U.S. technology, although it's fantastic, valuation has to make sense. And that's what I talk a lot about on this show, is that valuations, if you don't understand how to value stocks, you're not going to be in a good position when it comes to choosing stocks. You can't just choose it because someone talks about it on CNBC. You can't just choose it, as much as I like that you guys watch my videos, just because I put a video out. That should be nothing more than an ideas list for you. And you need to go in and do the due diligence. Number one, does it fit your strategy? Is the quality of the company okay? What is the valuation? Those are things that I go through within my 6-week investing accelerator course. Many of you are in here right now, and you know that checklist of items that we go through. So that is concerning. The other is, at the start of the show, we have our first slide that we always go through, right? And we look at the S&P 500 PE ratio. And if you noticed on there, and heard me say that the estimate, the $270 EPS estimate for the S&P 500 is still largely unchanged by many analysts there. So although the price has come down for the S&P 500, we're off of our highs. Again, not terribly off of our highs, as much of the negative news that's out there. We slightly dipped into a correction the other day and jumped up on Friday, and we jumped up here today. But the EPS estimates are still the same. So if you have think of a price to earnings metric as stock price divided by earnings per share. If the stock price comes down, which the S&P 500 did, we have less of a gap now. So that valuation is lower. That's good. But now if the economy does start to falter and those expectations come in and come around earnings season, you see a lot of the big time tech companies, the largest companies in the S&P 500 say, hey, the first quarter wasn't great at all. And now we're implementing tariffs that are starting on April 2nd. We need to revise our EPS estimates and we need to lower them. If that starts happening here in this next earnings season, we could see a little bit of a bloodbath here, because now we take that 270, although the S&P 500 prices come down, now that 270 goes down to maybe 250. And all of a sudden, our valuation gap is right back where it was. Even though the S&P 500 came down, we have to reevaluate again because the estimates have changed. They are a bit of a moving target. They're estimates, okay? So that's definitely something to be concerned about moving forward. And we're going to know a lot more in earnings season. Again, the end of March, right after that, first couple weeks of April is when everything starts launching off here again. So outside of the U.S., areas are doing fine. China's getting back to growth. Even if you look at the Canadian markets where we've had the tariff talk, even if you look at Mexico's markets where we've had the tariff talks, those markets are actually doing pretty well right now. So definitely things to look at for both sides. So some other things in the news here, housing starts. That's something I like to look at in terms of if people are spending on housing, that gives me a little bit of a more comfort as an investor that the consumer is okay. And the first thing that goes on when it comes to the first process is going to be permits, and it's going to be housing starts. So what are the home builders looking at? And what we saw here in the March reading that came out yesterday, we saw 11.2% month over month increase. So that was the big boost. That was unexpected there. But again, as I always tell you guys, never let one data point change everything. We've seen that with the Fed before. Let's see if we can get a bit of a trend going here with that. and investors are looking elsewhere. So S&P 500, as I mentioned, down roughly 4%. However, the equal weighted S&P 500 pretty much flat on the year. Look at the Vanguard Value ETF. It's up 3%. SCHD is up 3%. So if you've built a well-diversified portfolio, you're probably doing fine. But if you have 80% of your money in technology, you've probably felt that volatility. It's been a great 2 consecutive years here, but you can't just ride that train forever there. It's still smart to be overweight into technology, but 80%, a little bit too much for me in particular. You look at the Mag 7, they're down 14%. You look at the NASDAQ, down almost 7%. You look at the equal weighted NASDAQ, though, everything isn't falling apart. It, again, is pretty much flat, down 0.5%. So it's not everything is selling off here. Don't believe all of that negativity that's out in the markets right now. It's important to get perspective. It's important to take a step back and not let any of this madness cause you to hit the sell button without you knowing why. I always tell people you should have a thesis on why you're buying a stock, and you should have a thesis and a reason on why you're selling it. The answer should never be because you just got scared and just said, "Hey, I got to get out of here." Okay? So definitely things that I wanted to touch on right there. And then another thing I want to touch on is our stock madness. Stock market madness is back, folks. This is free to join. There's a link down in the description below. All of these are due today. So if you want to fill out these brackets, it's all based on actual stocks, individual stocks here, ones that you believe are going to outperform over the next 12 months in terms of performance. You fill out the bracket entirely, and we have gifts to give away. Again, it costs nothing to join this. It's just a free, cool little fun event that we do at the Stock Investors Edge every single year. So definitely check out that, get your brackets in, email them to us, and we will get you included into that. So that's pretty much the show I got for you guys today. Again, I wanted to mention our stock options workshop is tomorrow, 8 p.m. Eastern time. And again, if you cannot join us right out of the gate, that's okay. You're going to get a recording to it. You will get the recording to look back. And this is one that you do not want to miss. There's a lot of fear in the market, and I'm going to show you strategies that you do not have to go and sell positions that you don't want to sell. There are ways to build in hedges utilizing options, okay? There are ways to, if you like certain stocks and you want to potentially buy them at way reduced costs, you can get paid to wait. We're going to go through that, a number of examples, show you the pros and cons of certain strategies, the exact strategies that I utilize to generate over $5,000 per month. Again, stock options is what takes your investing to the next level here, guys. And you can check out the link down below. Save your seat. We only have a limited number of seats. We can't just let everyone into this particular program here. We only open it up to a select few, a select number of folks. So definitely make sure you get signed up as quickly as possible and save your spot. Again, you do not have to join live, but if you are, you will be able to join the Q&A and drop those in as well. So again, thank you guys for joining me today. It's always a pleasure to speak with you guys and keep getting through this stock market volatility. I believe that volatility is going to remain, but in the near term, I think we can have a solid little run here up until earnings season. All bets are off at that point right there. So we've had a nice little pullback here, but I do expect in the near term volatility still to remain, but we could see a nice little run up here. So definitely, I always say I'd rather stay invested. I want time in the market over trying to time the market. Trying to time the market is usually a losing strategy from that standpoint again. So thank you guys for joining. It's been great, and we'll see you next week. Take care, or we'll see you tomorrow at the Stock Options Workshop.